Hi, and welcome to this edition of the Options Learning Center. My name is Rick Orford, and I've been a stock and options trader since 1999. And today, I'm excited to explore the protective collar and how to use bar chart to get the most out of the strategy. The protective collar is a hedging option strategy that involves holding shares in a company or an ETF, and then selling an out-of-the-money call and buying an out-of-the-money put option on the same underlying asset, all with the same expiration date. This strategy combines a covered call and a protective put, resulting in a net debit or credit depending on market conditions. A protective collar limits downside risk while earning premiums from the short call, but limits the overall profit potential from the trade. Like a married put, a protective collar can profit in two ways. First, when the price of the underlying stock moves beyond the short call's strike price and the option is exercised, the stock is sold. The maximum profit is limited and calculated by taking the difference between the purchase and strike prices and then adding or subtracting the debit or credit, whichever is the case. Second, the trade can profit if the stock's price undergoes substantial downside movement before expiration, in which case the put can increase in value and be sold for a profit, though this will depend on market movements. The maximum loss of a protective collar happens when the underlying price goes below the long put strike price and the trader exercises the put. The maximum loss is the cost base on the underlying security plus the premium paid if the setup results in a debit, or less the premium received if credit minus the strike price. A collar trade can be set up by either looking for new opportunities, which means buying the underlying security, selling the call, and buying the put, or it can be done on stocks or ETFs that you already own. Next, I'll show you how to scan the entire market for collar trades, and then later, I'll show you how to find trades on a specific stock or ETF. Let's head over to barchart.com to look for protective collar trades. Once you're there, click on Options at the top, then look for Protective Collar. This will immediately bring you to the results page where you can find likely protective collar trades. The default results page includes relevant information like strike prices, premiums, costs to enter the trade, and more. Each column header can be clicked, allowing you to arrange the results from highest to lowest or lowest to highest of your chosen column header. These results are already a good start. However, if you want a more granular search, you can click on the Set Filter tab at the top left of the page. This brings you to the Options Screener page, which contains default filters for this specific strategy. To add filters, you can click on the Add a Filter field, and then type in your preferred selection. These filters range from option details to stock and company information, such as financials, technical analysis, and so on. With that, you can tailor fit your screens to your heart's content. Now, the default filters are perfectly fine for most traders and will give you a healthy balance of risk and reward. However, I do want to point something out. Let's move down to Delta for leg 1. This is your short call. And in a collar trade, you don't normally want your shares to be called away. So Delta will help us make the right choice. Delta is a measure of how much an options premium changes relative to a $1 change in the underlying price. But it can also be used to measure the probability of an option expiring in the money. Since we want to keep our shares, you want to trade with a low probability of expiring in the money. Now, when you're selling a call, the delta appears as a negative, and the default value is negative 0.25. That means the short call has a 25% chance of getting assigned, or a 75% chance of expiring out of the money. So all I have to do now is click See Results to get the potential trades that fit the default criteria. By the way, you can also save your screener to reuse it later. You can also have Barchart email you at a specified time with your trades. Just click the Save Screener near the top right, and then type in the name of the screener, and click on when you want the email to arrive. Now, callers can result in a net debit or a credit. So I'm going to click on the net column up here to find all the trades that end up in a credit. This means I'll be paid to enter this trade. For illustration, we'll take the first trade suggestion on this list. According to the screener, you can buy 100 shares of Microsoft for $438.69 a share. That'll be your cost base for the underlying stock. Then you can write a $475 strike call and collect $5.10 per share. After that, you can buy a $370 strike put and pay $1.61, bringing your net credit to $3.49 a share, or $349 per contract. All options expire on November 11th, 51 days from the scan, and the short call has a delta of -23, or a 77% chance of the call expiring out of the money. This means that you get protection below the $370 strike at the expense of capping your upside at $475 on the Microsoft shares. With those details, let's discover what could happen on the trade. The ideal and most likely scenario for this trade is for Microsoft's stock price to stay below the short call strike and above the long put strike. If that happens, both options expire worthless, meaning that you get to keep the $349 credit that you collected at the start of the trade and your 100 Microsoft shares, which you can use for another protective collar trade. Now, let's say that Microsoft stock reaches $500 at expiration. Instead, your short call gets assigned. And in that case, you're going to have to sell your 100 shares for $475. To calculate the profit on the trade, subtract your stock's purchase price from the strike price. And that works out to $36.31 a share, or $3,631 per contract. But don't forget, you also received $3.49 per share for the collar, bringing your total profit to $3,980 per contract total. But with your short call, you'll lose out on roughly $2,500. That's the opportunity cost, but that's the cost of the collar. On the other hand, if the price of Microsoft experiences a significant downward movement to, let's say, $300 at expiration, your long put is now in the money, while your short call expires worthless. Instead of taking the loss by selling the shares at $300, you can exercise your long put and sell your Microsoft shares for $370. That way you'll mitigate some losses. To calculate the maximum loss, subtract the strike price from your cost base, which works out to a loss of $68.69. But don't forget to add the net credit that you received at the start. So your net loss would be $65.20 a share, or $6,520 per contract. Here are the different profit and loss scenarios for different price points to better understand how this protective collar trade could turn out, provided, of course, that the call is assigned or that the put is exercised at the relevant prices. As you can see, with this trade, the maximum profits and losses are capped at $3,980 and $6,520 respectively. As I mentioned earlier, protective collars are typically used on assets that you already own. Let's say, for example, you own 100 Microsoft shares and you want to trade a collar with that underlying security. If that's the case, you can go to barchart.com and search for your owned asset to look for protective collar trade ideas. Once you're at the stock's profile page, navigate to the left-hand side of the menu and look for protection strategies. And then click on protective collar. From there, you can change the short call strike or change the expiration date on the dropdown. And if you want to further refine the matches, you can hit the screen link and set filters. It's that easy. The biggest advantage of a collar spread is its protection against significant downside price movement. Not only that, the short calls premium offsets the cost of downside protection. And depending on your risk tolerance, it can even result in a net credit. However, a protective collar effectively limits your profitability, and the protective put comes with associated costs. It's also a complex strategy with two trade legs, and there's the risk of assignment to consider, which means there's opportunity loss if the stock moves significantly above the short call strike price. The protective collar can be an excellent hedging strategy to protect your shares from short-term volatility while potentially earning a premium. However, every trade is different, so it's important to review your strategy to determine if the results fit your trade preference and risk tolerance. To get a 360-degree view of your trades before starting them, use every resource and utility at your disposal, including the option screeners. And of course, if you need more information, don't hesitate to visit the Options Learning Center, where you can find out more information about protective collars and all the other available trading strategies.